other sources. Provisions related to interest on securities and allowable deductions. Interest on securities. A security is a document acknowledging the debt taken by the government, local authority, or a company from the public. It is held by an investor or creditor as a guarantee of his right to receive payment. Interest is the return received by a creditor for giving his money as debt. If securities are held as investments, then interest is taxable under the head income from other sources. Whereas, if securities are held as stock in trade, then interest is taxable under the head profits and gains from business or profession. Basis of charge. The chargeability of interest on security depends on the accounting system followed by the assessee, that is, cash system of accounting or mercantile system of accounting. If cash system of accounting is followed by the assessee, then interest will be taxed on receipt basis. In case of mercantile system of accounting, interest will be taxed on due basis. There are 4 types of securities. They are: number 1, tax-free government securities, less tax government securities, tax-free non-government securities, and less tax non-government securities. The first type of security is tax-free government securities. The interest on these securities is fully exempted from tax as per section 10 subsection 15. Interest on the following securities is fully exempted from tax, and these securities are 12-year National Savings Annuity Certificates, National Defense Gold Bonds 1980, Special Bearer Bonds 1991, Treasury Savings Deposit Certificates 10 years, Post Office Cash Certificates 5 years, Post Office National Savings Certificates 12 years or 7 years, Post Office Savings Bank Account. And in case of Post Office Savings Bank Account, in case of individual account, maximum exemption limit in case of interest is Rs 3,500, whereas in case of joint account, maximum exemption limit for interest is Rs 7,000. Post Office Cumulative Time Deposit Account 15 years, Public Account in Post Office. It is exempted up to Rs 5,000. Next is Fixed Deposit Scheme governed by the Post Office Fixed Deposit Rules 1968, Fixed Deposit Scheme governed by the Government Savings Certificates Fixed Deposit Rules 1968, National Plan Savings Certificate 12 years, National Plan Certificates 10 years, Special Deposit Scheme 1981, Gold Deposit Bonds 1999. Bonds issued by the local authority and specified by the central government, interest on 7% capital investment bonds, interest on notified bonds or debentures of public sector companies, interest on securities held by the Welfare Commissioner of Bhopal gas victims in the Reserve Bank. The next type of security is less tax government securities. These securities are issued by the central government or state government. These are taxable securities. Interest on these securities will not be grossed up. no TDS on these securities. An exception is tax will be deducted at source on interest on savings taxable bonds 2003 if the amount of interest exceeds rupees 10,000 during the previous year. The next type of security is tax-free non-government securities or commercial securities. These securities are issued by a local authority or a company in the form of debentures or bonds. These securities are called tax-free because the assessee need not pay tax on these securities. The tax paid by the company on this interest is deemed to have been paid on behalf of the assessee. By the company on the interest due to an assessee is added to his interest income, that is, interest on these securities should be grossed up. This grossed up interest is included in the income of the assessee. Example, a company has issued rupees 1,12,000. Example, a company has issued rupees 1,20,000 6% tax-free debentures. In this case, the debenture holder will receive the entire amount of interest calculated at 6%. Taxable interest is equal to amount of interest actually received by him plus income tax on interest paid by the company on behalf of the debenture holder. And the answer for this problem is rate of income tax for debentures issued by a company is 10%. Therefore, interest on debentures is equal to 1,20,000 into 6 by 100, which is equal to rupees 7,200. This 7,200 is the amount of interest on debentures. 10% income tax is paid by the company on behalf of the debenture holder. So the interest should be grossed up. So gross interest taxable is equal to interest received into 100 divided by 90. That is 100 minus 10, which is equal to 90. So interest received is 7,200 into 100 divided by 90, which is equal to rupees 8,000. Therefore, gross interest taxable in this case is rupees 8,000. The next type of security is less tax non-government securities or taxable securities. In case of these securities, income tax is deducted at source on the amount of interest at a specified percentage or rate. The balance interest after deduction is paid to the security holder. Only the gross amount of interest is included in the income of the assessee. If the rate of interest or percentage of interest is given in the problem, then there is no need to gross up. Calculate the amount of interest and include it in the income of the assessee. That is, in this case, if the rate of interest is given, directly calculate only the amount of interest and include it in the taxable income of the assessee. If the net amount of interest is given, then such interest should be grossed up. Example, rupees 7,200 received as interest on debentures of Mega Limited, not listed in any stock exchange. The answer for this example is, in this example, rate of interest is not given. Instead of the rate, the net amount of interest is given. That is rupees 7,200 interest amount is given. So the net interest should be grossed up. Rate of income tax for debentures, whether they are listed or not listed, is 10%. Therefore, taxable interest on debentures is equal to amount of interest, that is 7,200 into 100 divided by 90, that is 100 minus 10, which comes to rupees 8,000. The next example is rupees 7,500, 10% debentures of a jute mill company. In this example, rate of interest is given. Therefore, the amount of interest taxable is 7,500 into 10 divided by 100, which is equal to rupees 750. Let us now look at the deductions allowable under the head income from other sources according to section 57. The first one is interest on securities or dividend from a foreign company. Deduction in case of this income is equal to any reasonable amount paid to a banker or any other person for collecting such income, to be short, collection charges. The next one is income by way of letting out plant, machinery, furniture with or without building. And deduction in case of this income is repairs, insurance premium and depreciation. The next income is family pension received. Deduction in this case is least of the following is allowed as deduction. That is, a standard deduction of rupees 15,000 or 1/3 of the family pension received, whichever is less, is allowed as deduction. The next income is income from subletting of a house, and in this case rent, repair charges, etc. regarding sublet portion of the house can be claimed as deduction. Next is interest received on compensation or enhanced compensation, and deduction allowed in case of this income is 50% of such compensation. In case of other income such as royalty, examinership remuneration, etc., and expenditure incurred to earn such income can be claimed as deduction. And conditions to be fulfilled are: it should not be a capital expenditure or a personal expenditure of the assessee. So capital expenditure and personal expenditure of the assessee can't be claimed as deduction. And expenses incurred in connection with exempted income also can be claimed as deduction.